Welcome back. In the last lesson, we built your foundation in price action, reading charts, identifying trends, understanding where price is likely to go. Now it's time to introduce the actual instrument we're going to be trading, options. If you've heard the word options and imagine something complex, risky, or only for Wall Street professionals, I want to reset that. Options are incredibly logical once you strip away the jargon. And by the end of this video, you'll understand what they are, how they work, and why they can be far more powerful than simply buying or selling stock. Let's get into it. The core definition, a right, not an obligation. Here's the single most important thing to understand about options. An option gives you the right, but not the obligation, to buy or sell an asset at a specific price on or before a specific date. Read that again. The right, but not the obligation. This distinction is everything. When you own stock, you own it. If the price falls, you lose money, but with an option, you have the right to act. And if the situation isn't in your favor, you can simply choose not to. You walk away. The most you lose is what you paid for the option. Let me give you an analogy that makes this crystal clear. Imagine you're interested in buying a house. The seller and you agree you'll pay $500 today for the exclusive right to buy that house for $300,000, but only for the next 30 days. During those 30 days, you can investigate the property, wait for a better market, or find a buyer yourself. If the house turns out to be worth $350,000, you exercise your right, buy it at $300,000, and you've made a great deal. If the house turns out to have a flooded basement and it's only worth $200,000, you walk away. You lose your $500, but that's it. You're not obligated to buy a bad deal. That $500 you paid, that's the premium. The $300,000 price you locked in, that's the strike price. The 30-day window, that's the expiration. We'll come back to all three of these, but first, let's talk about the two types of options. Calls vs. puts, the two sides of every contract. Every options contract in existence is either a call or a put. A call option gives you the right to buy the underlying stock at the strike price. You buy a call when you think the stock is going up. If the stock rises above your strike price, your call gains value. You've locked in the right to buy cheap in a market that's gotten more expensive. A put option gives you the right to sell the underlying stock at the strike price. You buy a put when you think the stock is going down. Think of a put as insurance. If you own shares of a stock and you're worried about a decline, a put protects you by locking in the price you can sell at, even if the market collapses. Calls profit from rising prices. Puts profit from falling prices. Together, these two simple instruments can be combined in dozens of strategies, but you have to own these basics first. Strike price, expiration, and premium. The three core terms. Every options contract has three defining characteristics. The strike price is the price at which you have the right to buy or sell the stock. If you own a call option with a $150 strike price on a stock, you have the right to buy that stock at $150, even if it's trading at $180 in the market. The expiration date is the deadline. After this date, your option ceases to exist. It expires worthless if it isn't in a profitable position, or you can exercise it if it is. Options come in weekly, monthly, and longer dated expirations. The date you choose matters enormously. We'll cover the time factor in depth in Course 3. The premium is the price you pay for the option contract itself. This is quoted per share, but since each contract covers 100 shares, more on that in a moment. The actual dollar cost is the premium multiplied by 100. If a call option has a premium of $3, you're paying $300 for one contract. Strike price, expiration, premium. Know these three terms cold. They'll come up in every single conversation about options. ITM, OTM. Where's the strike relative to the stock? Here's a set of terms you'll see constantly in the money and out of the money. Let's break them down visually. Say a stock is trading at $100. An option with a strike price of $90 for a call is in the money, ITM. Why? Because you already have the right to buy at $90 a stock that's worth $100. There's already built-in value there. An option with a strike price right at $100 exactly where the stock is trading, is at the money, ATM. You're right on the line. An option with a strike price of 110 for a call is out of the money, OTM. The stock would need to rise above $110 before that call has any intrinsic value. Right now, you're buying potential, not realized profit. For put options, it's the mirror image. $110 put on a $100 stock is in the money because you have the right to sell at $110 when the market price is only $100. A $90 put is out of the money. Why does this matter? In the money, options are more expensive. They already have value baked in. Out of the money, options are cheaper but require the stock to move more for you to profit. Neither is inherently better. They serve different purposes depending on your strategy. Intrinsic versus extrinsic value. Every options premium is made up of two components, intrinsic value and extrinsic value. Intrinsic value is the real tangible value the option already has. It's the difference between the stock price and the strike price when the option is in the money. A $90 call on a $100 stock has $10 of intrinsic value. Extrinsic value, also called time value, is everything else. It's what you're paying for the possibility that the option moves further in your favor before expiration. It includes time remaining until expiration and implied volatility, which we'll discuss in detail in Course 3. Out of the money options are 100% extrinsic value. There's no intrinsic value yet, just hope and time. As expiration approaches, that extrinsic value erodes. This is one of the most important forces in all of options trading, and it works for sellers and against buyers. Who is on the other side? Buyers versus sellers. When you buy an option, someone on the other side is selling it to you. The buyer and the seller have completely opposite experiences. The buyer pays the premium and has a right. The maximum loss is the premium paid. The potential gain is theoretically unlimited for calls or substantial for puts. But buyers need the stock to move and move enough and soon enough. The seller, also called the writer, who collects the premium and takes on the obligation. If you sell a call option, you're obligated to sell the stock at the strike price if the buyer exercises. The seller's profit is capped at the premium received, but sellers have a powerful advantage. Time is on their side. As every day passes, the option loses extrinsic value, and the seller keeps that decay. This is a crucial dynamic. Most options buyers lose money, not because the direction is always wrong, but because they underestimate how much the stock needs to move and how quickly to overcome time decay. We'll explore this in Course 3. The options chain, reading it on any platform. The options chain is the table you'll look at on any brokerage platform to find available options for a stock. It might look overwhelming at first glance, but it's very logical. The chain is organized by expiration date at the top. Within each expiration, you'll see a list of strike prices running down the center. To the left are call options. To the right are put options. For each option, you'll see the bid price, the ask price, the last traded price, the volume, open interest, and the Greeks, which we'll cover in a future lesson. The bid is what buyers are willing to pay. The ask is what sellers are willing to accept. You typically buy closer to the ask and sell closer to the bid. The difference between the two is called the spread. When you're analyzing a trade, you'll look at the chain to find the right strike and expiration, then check the premium to understand your cost and potential risk. Contract size. One contract equals 100 shares. Here's something that trips up almost every beginner. One standard options contract controls 100 shares of stock. So if you're looking at an option with a 2-point premium, your actual cost is $200 per contract, not 2 points. If the premium is $5.50, you're paying $550 per contract. This is important for two reasons. First, options are leveraged instruments. One contract gives you exposure to 100 shares of stock without buying 100 shares outright. Second, your profit and loss calculations all need to account for that multiplier. A 1.00 increase in option premium means a $100 gain per contract. Always remember, multiply by 100. American versus European options. Most stock options traded in the US are American style options. This means you can exercise your right at any time before expiration, not just on the expiration date itself. The flexibility has value. European style options can only be exercised on the expiration date itself, not before. Most index options like SPX, the S&P 500 index, are European style. For most of what we'll cover in this course, we're focused on American style equity options. Just know the distinction exists. A real world example, buying a call. Let's put it all together with a concrete example. Say you've done your price action analysis from course 1. You've identified that Apple stock trading at $175 is in a clear uptrend, holding above its 50 EMA, and just bounced off a key support level on strong volume. You're bullish. You could buy 100 shares of Apple for $17,500, or you could buy one call option. You go to the options chain and select an expiration 30 days out. You find a call option with 180 strike price trading at a $3,000 premium. You buy one contract for $300. Here's what can happen. If Apple rises to 190 by expiration, your $180 call is now worth at least $10 of intrinsic value. So it may be trading around $10.50 or more. Your $300 investment has grown to $1,050 or more. That's a 250% return on your money, on a stock that only moved about 8.5%. If Apple goes nowhere or drops, your $180 call loses value. In the worst case, it expires worthless and you lose your $300 premium. That's your maximum risk, and you knew it before you entered. That's the power of options. Defined risk, leveraged reward, and the ability to express a precise directional view. In our next lesson, we're going to go deeper into what actually drives that 3.0 premium. Why is one option priced at $3 and another at $15? What forces cause options to gain or lose value? The answer involves time, volatility, and a famous formula. See you in Course 3, the end of script. Course 2, what is an option?